Hi, my name is Alex, and I'm a public education economist and economics teacher at the Reserve Bank of Australia. In this video, I'll give a brief summary of current economic conditions and an overview of the bank's recent monetary policy decisions as at November 2023. This information is drawn from the Reserve Bank's November Statement on Monetary Policy and is aimed toward high school economics students. Let's start with Australia's economic growth. The Australian economy is currently experiencing a period of below-trend growth. The black line is the quarterly growth rate in Australia's GDP. This line shows that Australia's GDP growth slowed over the first half of 2023. Now focus on the yellow bars. This represents real GDP per capita. To calculate real GDP per capita, we take the total value of real GDP and divide it by the size of the population. This gives us a measure of each person's share of real output in the economy. It's a way of assessing living standards. When real GDP per capita is higher, so too is real income per capita, which increases people's ability to purchase goods and services. Real GDP per capita declined over the first half of 2023. The term real means we are taking inflation into account. So what are the key factors in the slowing economic growth rates? Cost of living pressures, including the cumulative effect of increases in interest rates since May 2022, have been weighing on people's real incomes. Let's have a closer look at household incomes. Household disposable income, the black line, refers to income that's available for spending after deducting tax and interest payments. Annual growth in real household disposable income has been declining since mid-2022 and has become negative. Looking at the latest value for the June quarter, we can see that it was 3% lower than a year ago. The coloured bars show the contribution of different factors to household income growth. The red bar, income for labour, has grown robustly and contributes positively to disposable incomes. However, this growth has been more than offset by the following factors that reduce people's disposable incomes: high prices, the dark blue bars, strong growth in tax payments, the light blue bars, and the higher net interest payments from higher interest rates, the yellow bars. The net result has been declining growth in household disposable income. And falling real household incomes have been a key driver of weak consumption growth over the past year. With less money available to spend, overall spending growth has slowed in the economy. We'll now take a closer look at consumption. As we can see in the graph, household consumption growth has been subdued in recent quarters. The blue line represents overall household consumption of goods and services, while the red line represents household spending at shops like supermarkets, department stores and cafes, also known as retail sales. The slowdown in growth has been due to lower spending on discretionary items, such as luxury goods, while growth in the consumption of essential goods and services has remained steady. Even with this weakness in consumption growth, there are two factors giving Australia's economic growth rate some positive momentum: stronger than expected growth in population and more strength in the growth of private and public investment. Let's start with the population point. The black line shows the quarterly growth in consumer demand in Australia. Consumer demand consists of growth in spending by Australian residents plus spending by people travelling to Australia, travel exports, or less the money spent by Australians overseas, travel imports. The blue bars represent spending by Australian residents. The orange bars represent spending by tourists and international students. This graph shows how at present consumer demand is supported by international students and tourists over the past year. This includes a large contribution from Chinese tourists and students since the start of 2023, despite a slowing economic recovery in China. Now to the growth in private and public investment. The black line represents total non-mining business investment in Australia. Growth in non-mining business investment over the first half of 2023 was the strongest outcome since 2007, aside from the pandemic rebound. Investment in machinery and equipment, the red bars, as a share of GDP has risen to its highest level in a decade, partly reflecting higher car and truck sales following a period when it was hard to buy these vehicles due to supply disruptions overseas. Non-residential construction, the blue bars, has also increased strongly. Very low vacancy rates and a large increase in rents for industrial property like warehouses have led to a strong pickup in building activity. Business investment and public demand are expected to continue to contribute to output growth in coming quarters, supported by strong population growth, an easing in supply constraints, and a large pipeline of projects, including for public infrastructure. Australia's labour market remains tight, but conditions have eased over 2023 as growth in labour demand has moderated, while growth in the supply of labour has remained strong. Australia's unemployment rate is still near historically low levels. Underemployment has risen over 2023, driven both by part-time workers preferring to work more hours and fewer part-time workers finding the hours of work that they would like. This graph shows the quarterly growth in full-time jobs, the red bars, versus part-time jobs, the blue bars, in the economy. In recent months, employment growth has increasingly been driven by part-time employment. The number of people who are employed is expected to continue increasing over the period ahead. However, employment is expected to grow more slowly than the working age population because the economy is forecast to continue growing below trend. The unemployment rate is expected to rise gradually over the next year to 4.25% from late 2024, which is a more moderate increase than previously forecast. Turning now to inflation. The Consumer Price Index increased by 1% in the September quarter in seasonally adjusted terms and by 5.4% over the year. This means, in year-ended terms, headline inflation has declined further. Underlying inflation, which removes the effect of irregular or temporary price changes, also eased further over the year, but this decline was less than expected in the September quarter, as services inflation remained high amid strong domestic cost pressures and still robust aggregate demand. Services inflation, including rents, has increased in recent quarters and is now contributing to a large proportion of inflation overall. Let's dig a bit deeper on services inflation. This graph shows price changes for market services. As their name implies, these are services for which pricing tends to be market-based, and they are generally driven by domestic factors, such as wages, commercial rents, and utility prices. Inflation in this category was stronger than expected in the September quarter. Within market services, prices for household services increased strongly, particularly for sports and leisure services. Prices for meals out and takeaway increased further, and insurance premiums increased significantly, reflecting higher expected claims and a reassessment of risk more broadly. Let's finish up by looking at monetary policy. The Reserve Bank Board raised the cash rate by a further 25 basis points in November, after holding rates steady at the previous 4 meetings. The board judged that an increase in interest rates in November was warranted to be more assured that inflation will return to target in a reasonable timeframe. High inflation makes life difficult for everyone and damages the functioning of the economy. The board's priority is to return inflation to target. Whether further tightening of monetary policy is required to ensure that inflation returns to target in a reasonable timeframe will depend on the data and the evolving assessment of risks. Thanks for watching the video. For further reading, have a look at the video description, where you can find links to the full statement on monetary policy, and visit our education page, also linked in the description, for other student-focused resources.